This is probably one of my favorite presentations that I've done, and we've been doing this throughout the year to help explain to advisors and our clients about how the economy works. And the reason this is near and dear to my heart is when I was in school, I struggled with economics classes, and it came down to the point of I finally figured it out once I was studying for the CFA exam, which is as humans, we don't always act like economists think we're going to act. So, my goal here today is to explain to everyone, first off, how our brains work, which will then influence how we make decisions and how we interpret data. And then I want to explain what truly moves the economy and what we're seeing right now at this current point here in the fall of 2023. So, the first thing we need to understand is this quote here, and I use this in pretty much all of my presentations, is that the stock market is a story of cycles and the human behavior that is responsible for overreactions in both directions. And this also applies to our economic analysis, where we see people overreact both when things are really great and also when things get really bad. What we typically see happening throughout our cycles is everybody goes through these different emotions at different points in time, but the market overall will also go through those emotions, and that can help really make it important to use data to determine what's actually happening beneath the surface. Now, I want to take a little bit of a step back, and again, I've talked about this in other presentations, so this is going to be the Cliff Notes version of what behavioral finance is. It starts with a book from 2017 from Richard Thaler called Misbehaving. And what I love about Richard Thaler is he was considered the black sheep of economists. And so when I started reading about him, I thought, hey, here's somebody I can actually understand, because like me, he struggled to understand these economic models and was really trying to figure out why in the world do these models that these professors are telling us should work aren't working. And what he came down to was economists, unlike any other discipline in the world who uses human behavior, assumes that everybody is perfectly rational, when in reality, as we all know, is that we tend to be irrational. So there's a few things that Dr. Thaler pointed out that humans are not very good at. And the first one is putting a value on things. He used the example of if you were given tickets to a game and it ended up being snowy, you're more likely to not go. But if you had paid for those tickets, you would tell people, "Hey, I'll go because I already dropped, now $400 or $500 for an NFL ticket." And that seems irrational because it should be the same value regardless of whether you paid for it or not. The other thing he found is that the way our brains think about money, I'm guilty of this. If I want something, I don't like spending money, so I'll ask my wife to get it for me for my birthday or Christmas. It all comes out of the same pool of money, but I'm not the one making the decision, so that it turns into her deciding that. So in my mind, it's not me spending the money, even though, like I said, it comes from the same account. That's irrational. The other thing Dr. Thaler found was we're terrible at understanding percentages and odds, which becomes important, of course, when we deal with investments and the economy. And then finally, we're really bad at making the right decision, regardless of how much data and research is out there. So we find this when it comes to economic analysis is, one, economic models don't always work because of the irrationality, but also the way we interpret what's happening in the economy is not always the way economists think that we're going to interpret them. So there's something else I think everybody needs to understand, and this becomes important as we're dealing with news out of Washington. We're recording this in late September when they're threatening to shut down the government because they can't agree on a budget. It's going to come up a lot during the next election, and it's going to come up really the rest of our lives. It's what really drives the economy, and there's a very simple mathematical equation that we can use to determine that. It comes down to how many people are working plus how much are they producing. So when it comes to economic growth, if you're looking at, okay, we want to get 3% economic growth, well, that means we need to grow the labor force and productivity by a combination of 3%. And every decision in Washington should come down to that of, are we putting more people to work or are we making them more productive? So put a pin in that. We're going to come back to that later. The other thing we have to understand is what truly drives the economy. And it comes down to this other equation: consumer spending plus investments plus government spending plus net exports. And when I say net, that means that we're going to add how much of our goods and services that we're selling to other countries and then have to subtract what we're importing from other countries. So the way that's looked, this chart here breaks it down by the different components. And you could see far and away the biggest contributor to economic growth is consumer spending. The data tells us that means we should focus the heaviest on consumer spending, but not lose track of the other components. When you look at everything, what you see happening is you could see consumer spending is 71% of our economic output overall. And then the other thing I want you to really focus on is long term. Imports have subtracted 19%, while exports have added 13. So the net effect is our trade deficit subtracts 6% over the long term to our economic growth. Again, we'll come back to that later. The other thing I want to look at, and I'll try to get my laser pointer here working, is looking at the different components and their growth rate over the years and how much it is factored in. Is you can see consumer spending by itself over the long term, going back to 1947, has added 2.3%. And then over the last 30 years, 1.9%, 10 years, 1.8%, and then over the past year, 1.6%. And you could see a one thing, it's shrinking. Again, we're going to talk about that here later. But the other thing that I think is different that we need to pay attention to in the current economic environment is we've actually kind of flipped the script in that imports, because they've dropped how much we're buying from other countries, it's actually a net effect of a positive on our economic output. Now, something broke, and we're going to talk about that here in a second, but the current economic environment is not the same as what we've experienced long term. But one thing we need to keep in mind is the question of, should we overreact to this change, or are we going to revert back to normal? And all of our data, spoiler alert, tells us we're probably reverting back to normal. So what we've experienced over the last year, really the last 3 years, is not normal. The other thing I want to look at is this orange line is the long-term growth rate of the economy. The dashed line is the trend in growth. And you could see where we blew way above trend after going way below trend here. And now the current level is below the long-term average. You can also see when you look back over the last, this part of the century, the last 23 years, we've rarely eclipsed the long-term average. And again, keep that in mind as we come back to the potential GDP growth equation here at the end. Now, how do we use this in our investments? And it's really important to understand the economic cycle because the stock market is a forward-looking mechanism. In other words, everybody on Wall Street and in London and Tokyo and everywhere else in the world where you have big pools of investors and analysts, they're all trying to guess which way the economy is going and then get ahead of that and allocate assets to those sectors that are going to do well. And so you can see this chart. The blue line is the economy. And you can see, in general, the way the cycle works is the stock market will turn before the economy does. And so typically what you'll see happening in the cycle is the stock market will bottom in anticipation of the end of a recession. And so what that means as far as sectors that are doing well is late in the recession, you'll see technology, industrials, and materials doing well. And then you'll start to see materials and energy staples and staples doing well. And then it jumps to energy, staples still, and then healthcare starts popping up. Well, then as signs of the economic slowing occurs, stocks overall begin to move lower because just in general, over the last 40 years, technology and growth type companies have had an overweight position in the S&P 500. So you see stocks start to roll over before the recession ends. But that doesn't mean you don't have some outperformance in certain sectors. So early in a recession, you'll typically see healthcare, utilities, and financial stocks doing well. In the middle of the recession, and this is something we're going to talk about here in a second, is Then technology starts to filter up to the top, along with cyclical type stocks, automakers, people that sell, refrigerators and big ticket items and things like that are more cyclical will start to outperform. And then we get to the end of the recession, stocks start to bottom, technology, industrials, and materials again start to outperform, but then we go back through the cycle. But what I think is interesting, and so we're doing this presentation in two parts. Right now, we're in September, we're talking about what really drives the economy and to get a better understanding of these economic indicators. Probably in November, we're going to come back around and we're going to talk about where is the economy now as we go into the end of the year and what should we expect in the year ahead. So stay tuned for that one. So the real question, though, that we have is based on the sector activity, we would really argue we're the stock market's saying we're mid-recession, if not turning in back into growth. Now, we didn't technically have a recession unless you use the simple explanation of two or more quarters of a decline in GDP, which we did have in 2022. So the technology stocks and cyclicals have just been vastly outperforming. Well, either way, technology stocks, either if we're going into a period of strong growth, they're going to start being less important to the growth of the market, and they're probably going to underperform other sectors. Or if the data that we're looking at is correct, and we're heading more back into an early recession, technology is not going to be at the top of the list either. So keep that in mind. So moving on, let's talk about the different leading economic indicators, and we try to break them down into four categories: jobs and workers, investment, housing and manufacturing, consumer spending, confidence, those types of things, and then what the government factors are right now. So we're going to look at each of those sectors. First off, employment indicators. My favorite one, and actually one of the best drivers and indicators of potential growth, is the aggregate weekly hours index. This comes out the first Friday, with a few exceptions, of every month, looking back at the last month. And I always look at this because as an employer, you understand that it's much easier to cut people's hours or increase people's hours than it is to hire somebody and have to then either lay them off or lay them off and have to hire them back. So the index of weekly hours tells us what's happening. And you can see the trend there is definitely down. It's still decently strong, but employers have been cutting hours recently. Payrolls also comes out on the first Friday of every month, most months with a few exceptions. It might be the second Friday, but you could see there that the trend is kind of flatlined, but it's still positive. It's some of the best job growth that we've seen this century, and so that is something that we should keep in mind, that for now jobs are still improving. However, jobs are what we call a coincidence indicator. In other words, they'll start dropping when we're already heading into a recession. So it's not that great of an indicator if you're trying to predict where the economy is going to be 2 or 3 months from now. What is a good predictor is initial jobless claims. First of all, we won't get into all the data out there and the ways the government has to estimate it. I love initial jobless claims because it's very difficult to tweak these numbers, because it's literally every state across the country sending into the government and saying, here's how many people filed for unemployment last week. Very simple. And so you're able to tell. So I flipped this chart because our brains, of course, think if something's going down, it's bad, and going up, it's good. So we want to look at jobless claims in terms of how far are they from the lowest level? In other words, what was the bottom, the lowest number of jobless claims? As jobless claims go up, that's bad. So I flipped this chart and we could see that we're in an area where jobless claims are 20% higher than they were 12 months ago. So that's a sign of economic strain. So we'll come back to summarize up all the indicators here at the end. Let's move on to consumer indicators. The first one, far and away, obviously the biggest driver of our economy, is consumer spending, 71%. It's just continuing to blow away expectations. So very strong there. I don't know what's going to get people to stop spending money. Probably some economic strain, probably some layoffs and other things that, student loan payments, things like that. Another one is service business activity. we've turned into a service economy. So you can look at where consumers spend their money, and it's on services. This indicator here, ISM services, tells us basically if it's over 50, it's an indication of expansion. If it drops below 50, it's an indication of a contraction. We're still strongly in expansion territory there. But I think what's most interesting here is consumer sentiment, because consumers overall are extremely pessimistic. Now, they're a little bit more optimistic than they were in the summer of 2022, but they're still less pessimistic than they were in April 2021. And over the long term, if consumers are not optimistic, they're less likely to spend money. So that's a major red flag when it comes to looking at consumer spending. And that's one of my favorite indicators to look at. In terms of what's happening in the economy right now and what's likely to happen in the next 2, 3, 4 months. So now let's look at the investment indicators. We're not a manufacturing economy anymore, but it's still a good 20-ish% of our economy. So it's important. And I'm not probably going to talk about it too much in this presentation. We'll touch on it. But it is important that we're going through a trend where we're reshoring jobs and production. And so manufacturing is going to become a bigger player. This is another ISM type survey where below 50 is negative. So even though the number is picked up a little bit, all of our manufacturing indicators are pointing to weaker growth. This is another one I love because it comes out the first day of every month to tell us what happened in the last month. So it's one that gives us real-time view of what's happening in the economy. The other one that I think is interesting, capacity utilization. Are we investing in more growth? Are we turning factories that were mothballed into more productive places? And we did see a nice pop coming out of COVID. Again, the reshoring I think is going to be important. But now it's kind of starting to flatline to the point of manufacturers are not using their full capacity like they were even 3 or 4 months ago. So that's something to keep in mind. But I think the biggest one is building permits. And this shows the percentage change from a year ago. And even though the numbers picked up, it's still negative. And what I love about building permits is it tells you the planned number of houses that are going to be going up. So I think of it as a leading indicator of economic activity. And not only does it help produce jobs and spending when a house is going up, but if you think about whenever you buy a home, all the spending that's involved with that, we need new blinds, we need new furniture, we need to put in a yard. We, might have a brand new area that doesn't have shopping around. And so now retailers are going to start building stores there. And there's so much economic activity around building permits. It's one that I pay very close attention to. It is nice to see that it's coming back close to the flat line, but it's still a slight drag on the economy. So now let's turn to the government. Government can be split into two things, but I'm really talking mostly about the Federal Reserve because they can tweak the economy much faster than Congress can. First off, money supply, it's shrinking because we had such high inflation. The Federal Reserve's trying to get money off the table. I put this chart up there. We've never seen this big of a drop in money supply since they started tracking money supply back into the late 1940s. The thing that I think is really important to understand is the yield curve. It's kind of been beat to death in the financial media to the point of people have said, well, we haven't had a recession, therefore the yield curve doesn't matter anymore, but it still matters. And the reason it matters is banks typically will pay you on deposits. They borrow money from their customers at short-term rates, which are typically lower, and then they lend money at long-term rates that are typically higher. That means they're making money, more money than they are having to pay in interest. Well, when the yield curve inverts, that starts to be a way of slowing down the economy to the point of it gets difficult to get a loan because banks are unwilling to take risks. And the Federal Reserve, way back when I was early in my career in the late 90s, had done a research report on is the yield curve a predictor of potential recession? And essentially the bottom line is yes, it is. But there's a 16-month lag from the time the yield curve inverts 2 months in a row to when we get into a recession. So if you back up to when the yield curve inverted for 2 consecutive months, that puts us right into the end of this year, 2023, of when we're heading to a recession. So the government, the way we're having to borrow money and the way the Federal Reserve has pushed interest rates is to that point. The other thing that I think is really important to understand is twofold. First off, the Federal Reserve had to raise interest rates very aggressively during the last two bubbles, and then they pushed us into a recession. So I think that's the most likely scenario that we see. The other thing to understand is the Federal Reserve cut interest rates aggressively before the recession. By the way, I should have mentioned every one of my charts on here, the red lines show us when we went into a recession. So you could see on this chart that the Federal Reserve was slashing interest rates, yet we still had a deep recession the last two times around. We even had one during COVID, although it was very, very short lived. The other thing, again, Federal Reserve research shows it takes 9 to 12 months for one change in monetary policy to filter through to the entire economy. So just like the yield curve inverting takes 16 months, the Federal Reserve hiking rates has not filtered all the way through. We're really sitting back to where we were at in August through October of 2022, which means we've only felt half of the impact of the rate hikes that the Fed has done. We still have that other half to go, and it just feels like the financial system is grinding to a halt, which is going to make it hard for the economy to grow, at least at the rates that the stock market is expecting. So now let's circle back to the potential GDP equation. How many people are working and how much are they producing? If you look at this, I plotted this back over time. Potential GDP is the solid line, and actual GDP is the dashed line. And you would say, well, this equation is not working. And I would say, you're 100% right. Remember, we're assuming that everything's rational, and we're assuming in this perfect world that there's no other outside factors. But we can see there are outside factors here when we look at things. We've been below potential over the long term in the last 30 years. The way we have to change this equation is we need to add some brackets here that tell us, oh, by the way, if we run a trade deficit and if we run a budget deficit where we have to pay interest, money leaves the US economy to go pay other countries for their goods and services, or to pay investors who loaned us money to finance our budget deficit. So the reason we've lagged long-term potential GDP growth is because of our two deficits, trade deficit and budget deficits. This becomes really important as you go into the election and when you evaluate candidates and you listen to all the noise coming out of Congress, in that if we're not putting more people to work and helping them be more productive, and instead we're doing things that increases our trade deficit or our budget deficit, we're not growing at potential and our economy is never going to reach potential. Looking at the data, I drew some critical lines. This is all the debt levels, with the dashed line being GDP in the United States. There's a couple of lines there. In 1984 was the first point the total debt in the US exceeded economic output. And then you go all the way to 2008, and that's where the level of debt just went exponential, or as I said, ballistic, where everybody, governments, banks, and corporations just went crazy borrowing money in order to save the economy. The only one that didn't go exponential was household debt. So that's really a problem that we have, is it's dragging our potential down, because guess what? Everybody has to pay interest on that debt. And if it didn't put more people to work and didn't make them more productive, you're shrinking the growth rate of your economy. The other thing I want to touch on, going back to the spring when we made this deal on the debt ceiling, there was 3 untouchable categories that both sides said, hey, we're not even going to look at these. And I plotted the spending as of 2022 along with the 2025 budget estimates, because they took off the table Medicare, Medicaid, Social Security, and defense spending plus VA benefits. Both sides said, you know what, we're not going to touch those. But if you look at this chart here, you can see why that's a problem. The untouchable money adds up to $4 trillion. We're only bringing in $4.8 trillion. In other words, we could literally wipe out the whole government and we could barely balance our budget. And of course, nobody's willing to wipe out the whole government because there are some important things happening in there. The other thing to keep in mind, and I don't have time here, check us out on TikTok or Instagram or Facebook Reels. We did a video talking about how Social Security and Medicare are problems because they don't put more people to work and they don't make people more productive. That means it's a drag on economic growth because we're having to borrow. The other thing you'll see here is by 2025, 2 years from now, interest on our debt is going to be the fourth largest spending category. It's going to exceed what we're spending on education and every other category in the government. It's only going to get worse the more money that we borrow. So now, looking at our economic dashboard, this is ranked in order of importance, and then kind of let's go through the different categories. Jobs, remember we had aggregate hours are still, the number of jobs are still good. Aggregate hours are tending to slow down. If you look at investment, housing, and manufacturing, you can see that most of them are negative. One of them's flat. You look at consumer spending, even though they're still spending aggressively, sentiment and the spending levels are coming back down to earth. So that's not really a net positive there. And then finally, government activity is also slowing down. So you can see a lot of flat to down arrows, which turns into our economic model, which we use inside of our dynamic investment models, basically saying it's bearish. It's not saying recession outright, but it's saying the economy is slowing. And that's important to understand. Is we're seeing a level of declining growth. What we've experienced the last 3 years is not normal. The government purposely broke the economy to fight COVID. Then Congress and the White House purposely threw in a whole bunch of money. They essentially put in half of our economic output in 18 months to try to fix it the other way. That didn't help. It broke a lot of other things. The supply chain, inflation went like crazy. And then the Federal Reserve had to try to break the back of inflation. So they've raised interest rates so much that the financial system is grinding to a halt. So how does this apply to you, whether you're a financial advisor or an individual investor with SEM or somebody else? There's lots of good investment advisors out there. Is, when somebody comes to me and says, I don't know what to do with my investments because I'm worried about a recession, or I think everything's going to be great and I want more growth, I come back to it and I say, we need to understand and base every decision from the standpoint of your financial plan and your cash flow strategy. So if you are a do-it-yourselfer, you better understand your financial plan and your cash flow strategy. How much money is coming in when you're working? How much needs to go out when you're retired? If you're working with an advisor, that should be the basis of every investment decision. If you don't have that, or you're not sure if you do, let us know. semwealth.com. There's a contact us button. You can let us know that you would like help figuring out your financial plan. Or if you're an advisor and you'd like to know how to apply this to your practice, definitely do that. The other thing that we do here at SEM is we use a bucket system. Just like I bucket out money and I ask for things I don't want to spend money on from my wife, it's important as investors to segment your money out into buckets based on when you're going to be spending them. At SEM, we have a whole lot of different investment options. How we allocate those is going to come back to your financial plan, your cash flow strategy, and your personality. And so everybody's going to be invested differently when they come to SEM. In general, where we're at as of August 18th, which is where we're at today at the end of September, was we're pretty optimistic short term, but long term we kind of have those economic models saying, hey, you better be careful. Finally, a little bit about SEM. We were founded in 1992. My business partner, Richard Gage, started the company. He's a metallurgical engineer. I joined in 1998. We manage about $850 million. We're available on a lot of different platforms. Again, semwealth.com has all of that information. So I really appreciate your time today. Again, more information at our website. We have our risk questionnaire. Whether you're an investor with SEM or not, that's a good starting point to say, am I invested in the right portfolio? I mentioned our TikTok and our Instagram pages. We post a lot of personal financial information on those pages. Definitely check us out. Finally, I write a blog every week. We post it on Mondays. You can find it there halfway through our page under SEM Market Insights. So thank you for your time. Keep following us for more content.